I will now be introducing Andy Albertson, partner at Fenwick & West, and he will be discussing how to negotiate with investors. Andy represents companies at all stages of development, ranging from mature public companies to founding teams with only a business plan and a vision, as well as many venture capital and private equity investors. For early stage companies, he ensures that they are built for and always planning for future success. Because he has seen hundreds of deals, he provides good and practical advice pertaining to key deal terms, alternative transaction structures, and how to avoid pitfalls. Andy is passionate about what he does and is a trusted advisor to some of the most innovative technology and life science companies in the country. Andy.
Great, thanks. Is the mics working again? Okay, great. So is there I guess I lost the clicker. There's probably something over here. All right, so how do you start with this sort of topic? How do you negotiate with investors? So let's start in the beginning. What are the types of investors in people that are investing in early stage, high growth technology companies? So let's start sort of in the beginning of the life cycle. Most companies that I work with raise at least some capital from angel investors. Primarily in the very early days, it's friends and families, but there's also professional angel investors, or at least people that are doing 10 deals a month, 100 deals a year, some number of checks in the ecosystem. And so the way you approach angel investors is going to be very different than venture capitalists. So let's talk about angel investors first. So as I mentioned, let's talk about some outreach. So people that you know. Oftentimes that first $500,000, a couple $100,000 is going to be from people that you have a pre-existing relationship with. There's not really an operating business at this point for people to make a bet on. And so these earliest investors, what they're doing is they're betting on a team. They're betting on you. So the question becomes, how do you expand your reach? So there's events. There's things like this. There's networking. There's happy hours. A lot of the venture capital funds put forth networking events that include angel investors, things like that. So if you're looking to network with angel investors, you should find events around the Pacific Northwest, Seattle, Bellevue, places like that. TIE is a good group. For life sciences side, Wings, which is the life sciences angel investing network. So it's really hand-to-hand combat. It's kind of hard to do it at scale. There's no replacement for going to events, shaking hands, meeting people, doing those types of things to get together an angel round. So let's talk about what does that look like when you're actually starting to run that process. So we're going to talk probably more about venture capital process, but for angel investors, I need to juxtapose to that. For angel investors, you're likely going to have to lead with some terms. So oftentimes there is this dilemma that I'm hoping coach people through of what's the company worth? What are the terms of the deal? And juxtaposing to venture, which we're going to talk about, in a venture deal, you're going to receive a term sheet and you're going to be in a reactive mode. For angel investors, for grandma that's putting in $50K out of her 401K, they're likely going to say, you tell me what the terms are. So the first friction point that we frequently have to resolve is, how do you set the deal terms? And so in any zero-sum negotiation, what I like to do is get the other side to lead with a number or terms. And so that's not always easy to do in this context because they're going to look to you to do that. And so it takes some diplomacy, right? And so oftentimes the message that we sort of craft that people are then going out in the wild and articulating is, something along the lines of, hey, I'm talking to lots of investors. Some are professional investors, some are angel investors, some are grandma, and I'm going to do a market check and I'm going to get a sense for what the company's worth. Because in a private company context, there's no valuation. You're not looking at EBITDA multiples. You're not looking at public company comparables. It really is art more than science. And so sort of crafting that narrative and then ending with saying, okay, look, and what do you think it's worth? Right? What would be a conversion cap if we were doing a SAFE or convertible note? What's a conversion cap or a discount that you would have appetite for? And so trying to do that and have that conversation with as many angel investors as you possibly can in order to get a sense for where is their actual appetite. It's not just you being diplomatic and trying to get them to give you a number. It is actually doing a bit of a market check. You want to understand where can I get consensus to do a round on. So once you run that process, so you've networked, you've talked to the people that already know you, you're having conversations, what you're going to do is you're going to get a consensus around a valuation. And so let's pause real quick. I don't want to get into the substance of structuring. That's a whole nother topic. But there are valuations when you price a company. So if you're doing like a Series Seed equity, and I'm only going to talk about early stage financing. Series Seed equity, where it's a preferred stock, you're selling at a valuation. Then there's convertible notes and safes, right, that are derivative securities that convert into a future round of financing. And they're going to have different terms. So the first thing that you negotiate is typically the headline price, the valuation. So in a priced round, what is the company worth on a pre-money valuation? And in a convertible note or a safe, there's typically really only two things you're negotiating: the conversion cap and the discount. And those are kind of the parameters that you're negotiating. So the first thing you're going to negotiate is the valuation. Then the second term is oftentimes everything else. And so the next big ticket thing that might come up or that you'd be negotiating is board composition. So in most, and we're still talking now just angel deals, seed deals, this paradigm. So in this type of deal, we're going to try to not give up a board seat at all. Words to live by are: it's very easy to put people on your board, it's impossible to take them off. Because it becomes emotional. People say, why me? It becomes a very challenging exercise to remove somebody from your board. And so for angel deals, I'll tell you that the overwhelming majority of them are not going to get a board seat. Now, sometimes the exception is going to be a fund. There's a seed fund that puts in $500,000, $750,000 of $1 million round. Sometimes they will ask for a board seat, and we'll talk about sunsetting it and other things, so that's not a perpetual board seat. But that will be sort of the core terms that we're going to talk about in that negotiation, in that process. Valuation, and then what are the other terms that come out of it. And then obviously it's supposed to be seed equity, but the equity we talked about, so this is preferred stock, and you can go to seriesseed.com. We've made all the documents publicly available there. You can read them. It's a very simple, short-form version of a Series A financing. And then safes and notes. If you're familiar with Y Combinator, those safes are publicly available. They're just posted. They're pretty easy to use. And then a convertible note is essentially the same thing as a safe, but with a maturity, and it's an actual loan. So I'm going to pause there on angels and some of the process. Questions about this? Yeah?
What was the website you mentioned?
The websites I mentioned there's two of them. So you can go to seriesseed.com. Seed?
Okay.
Yeah, S-E-E-D. And then Y Combinator. And their forms are publicly available as well. Yeah?
Can you define safes?
Yeah, absolutely. So it's a simple agreement for future equity. And what it essentially is you're pre-funding an equity round. And so it's an agnostic instrument that will convert into your equity round. And so it's either going to have a conversion cap or a discount. And so the way the conversion cap works is, let's say you negotiate $1 million round with a $5 million conversion cap. And then you go out and do a $10 million round. No matter what you price that Series A, let's say, at, the safe money is going to convert at that discount, at that conversion cap. The discount feature is same concept. We did $1 million round, or we did $1 million safe round, and we went out and did an equity round at a $10 million valuation, some discount to that price per share, 10%, 20%. Those are sort of the normal numbers that you see in terms of a discount off those rounds. And so when you're negotiating this first round from angel investors, those are the terms that you're frequently negotiating, is how's it going to convert into equity in the future? Yeah.
And then how do you feel about pay-to-pitch programs?
So the question was, how do I feel about pay-to-pitch programs? And the answer is not good. So there's Alliance of Angels, there's Wings, there's Tide, there's a lot of programs out there that don't charge people to pitch. I can tell you that I don't believe that I've ever had a client or myself have a great experience with one of the forums that says, hey, look, you can spend money to come talk to our investors. I just have never seen a good outcome with that. Doesn't mean that it hasn't happened. I'm sure that it has because they're still here. But it's not something that I've seen with great success. Yeah.
So besides valuation and the percentage of the share of the ownership, what are other terms that matter most to the investors?
The terms so we're still talking about seed, and just so you guys know sort of the agenda here, we're going to talk about things at a macro level, and then I have some of the core term sheet level points that you're going to negotiate. So we're going to get into some of the substance, but it's primarily on the venture capital side, the Series A side, we're getting into the substance. So on the Series Seed, or on the seed level financing, there's not a lot of other terms. So the way Series Seed documents work on the equity side, it's the price, it's board, then the next one is going to be the right to participate in future financings. So it's either called pro rata rights or preemptive rights. And this is a big one. So this is one of the points that causes the most trouble in future rounds. So what this term is when you go do your next financing, do I have the right to participate in that financing? And the most reaction is, sure, I don't care. I mean, your money is green. I would, like if you want to keep supporting the company in the future, that's great. Most angel investors don't have the dry powder to keep supporting a company as they raise larger and larger rounds. However, it's one of the most problematic provisions because what happens in reality is, there is a herd mentality with startups. You've probably heard this before or experienced this firsthand, but I couldn't tell you how many companies I've worked with, and we are struggling to raise capital to find that first round, and then all of a sudden, boom, you get a term sheet from Foundry, right? Or somebody like a top-tier venture capital fund. And now all of a sudden, you're white hot and everybody's throwing money at you, and now you have to turn to your angel investors and the people that previously supported you and say, hey, look, I'm going to raise $3 million, and the outside, lead investor is going to take 2.5. That's a deal term. I have $500,000 to go around and 20 angel investors to satisfy. I can't do it. And I have 2 other strategic investors that want to come in for the 250 that I think are going to add value and continue to support the company along the way. Thank you, early investor, grandma, whoever it is, for being my mentor, supporting me, but you're not going to get to participate. That's a very difficult conversation to have, just emotionally. These are real people that support you in the very early days. And now add a contractual legal underpinning to that, where the person says, see right here, I get 10% of the round. And so do all the other angel investors. And so that can really monkey with an existing round because now you have to go back to the lead investor and say, hey, you know what? I know how you want 2.5 of the 3. I have to give 60% of it to these people that are all writing $10,000 checks, $50,000 checks. I've seen it blow up deals. I've seen people burned by that. So that's sort of point number 3, I suppose, that we negotiate. Like I said, the series. Oh, yeah. Go ahead.
One quick question.
Yeah.
So I see VCs and angels up there. What if you get a strategic partner very early on? Can you sprinkle some comments on how you would go through this early process with a strategic partner as well?
Yeah. Yeah. So the question was, we're going to talk about VCs and angels, but let's also talk about some strategics and some of those issues. So let's define strategics real quickly. So if you are a software company, a strategic investor would be somebody like Microsoft, Cisco, people like that. And these companies, these large companies, Amazon's a big one that we see a lot, they have venture arms, they have incubators, they have programs where they're looking for new technology. Now, strategics are a bit of a double-edged sword. It's incredibly awesome to get a strategic on your cap table, A, because they have deep pockets, they have money. It's external validation. If Microsoft Research turns to their business arm and says, hey, this data analytics company is a super cool technology, we want to demo it internally, and we recommend you making an investment in it, those are great things. The primary problem is competitively sensitive information. So these companies, Microsoft's, Amazon, Cisco's of the world, they're not making investments out of the kindness of their heart. And they're not actually making investments for a financial return. Many of them are not. Some are. But primarily, that's not actually the objective. What they want to be able to do is get the early looks at the hottest technologies, support their development, almost like outsourced research and development. And then when that company goes to get acquired, goes public, whatever it is, they want what's called a right of first refusal, a right of first negotiation. There's a spectrum of things that we cover win those strategic deals that they want to do. But let's put that aside for a second. The more blocking and tackling is, they'll oftentimes ask for an observer. So let's unpack that a little bit. So there's a board member that investors will frequently ask for, a lead investor in a venture round. And there's something south of that, which is an observer. They don't get the right to vote. They're not a board member, but they get access to all the meeting minutes. They can attend board meetings. They can attend committee meetings. And I, sort of lovingly refer to them as the moles. Not when I'm representing Cisco, but when I'm on the other side, right? I mean, they're a spy in your camp. And so you have to be very careful. So there's the legal aspect of a right of first negotiation and all that kind of stuff, and I'll circle back on that. But there's the practical day-to-day stuff of, do I want Amazon's mole receiving all of my board information? So that's sort of the operational concern. Now from the legal one and the future investor concern, there's people that are of two minds on early stage strategic investors and how it impacts future venture capital financing. One side says that's great. It's validation. If Microsoft is in, their smart money, I'm in as well. Then there are people that say, whoa, most high-growth venture-backed companies don't go public, they get acquired. And if Microsoft is on the cap table and has an inside pull here, odds are they're going to be the acquirer. Well, what that does is it causes a chilling effect to other acquirers. If Microsoft is on the cap table, it's unlikely that Apple is going to want to come in and buy this company or take a look at it for a couple reasons. One of the primary ones is Apple's not going to want to be Microsoft's stalking horse. They're not going to come in, invest in the diligence, do all the types of things that it does to get a deal done, only to have Microsoft swoop in with their right of first refusal and grab the company out from under them. Not going to happen. And so a lot of founders and a lot of early investors and a lot of VCs do not want strategics on the cap table. The other side is they're going to leverage their network. Right? If you're an early stage company and you get Amazon, Alexa to support your company and invest in the company, are they opening doors for you in the natural language processing space? Are they putting their leverage behind it? So there's not a simple answer to the question of should you raise money from strategic investors. So the answer is actually it has to be right for your business, for your model, for your risk appetite, and then make sure that we are thinking hard about observers. When can we exclude them from information? And when are we going to give them a right to buy the company or not? And how are we going to structure all of those things? And there's a wide ranges of those things that you would do. And so in an ideal world, what I would do is first of all, it'd be no board member, no observer. You're purely a passive financial investor. That's probably not going to get legs. The next is that I heavily negotiate and fight for the right to exclude competitively sensitive information in our discretion. If we decide it's competitively sensitive, we're going to remove that. They likely then push back and want conflicts of interest only, which is something different than competitively sensitive. And that's how that's the game and the way you're negotiating the observer rights. Then on the right of first refusal to right of first negotiation to notice rights. So oftentimes what I will advocate for is it's not a right of first refusal. Let's define that real quick. If we're going to go sell the company for $10 million or $1 billion, you have the right to buy it at that price. Never going to agree to that. Right of first negotiation. If we decide that we are going to go sell the company, hire a banker to sell it, or get an unsolicited offer to sell the company, we'll go negotiate with you in good faith first. And if we get a deal done, great. If not, then we can go pursue this third party. And lots of frameworks on how you actually implement that. Then the third one that's much more palatable to me is a right of notice. If we decide that we're going to sell the company or we get an unsolicited offer to buy the company, we'll let you know. And that's great, right? Because what we're going to want to do in a situation where we're selling the company is run a competitive process, get all the horses lined up in the stalls, and then start cracking the whip. So we'd likely invite Microsoft to the party anyway. So if you can get a strategic deal done where they either don't have a board member or an observer, or we can loosely exclude competitively sensitive information, and we just have an obligation to give them notice that we're going to sell the company, that can be a great structure. The inverse of all of those things is me jumping up and down on the table screaming, don't sign the deal. Any questions on strategics or anything else that we've covered? No. Okay, so where were we? So we've talked about angels, the process, valuations, seed equity, safes, notes. Couple other quick points. There's no securities exemption for friends and family. That's one of the biggest pain points that we always have is, why can't I raise money from my crazy uncle from Utah? He says, well, if he's not accredited, then you're not going to have a valid securities exemption for that. So there's lots of issues around that, so flagging that issue. Okay, so venture capitalists. This is completely different than the approach you take with respect to angels. But let's start in the very beginning. Venture capitalists, when compared to, and even I'll talk about West Coast venture capital funds. The way that the good West Coast, either philosophically or geographically located, which is not always the same thing, but philosophically aligned West Coast venture capital firms, they are building companies, they're building teams. They live and die based on their reputation. If you watch Shark Tank or are familiar with the private equity shops of New York, that's not what this is. The people that are good VCs are investing in teams, supporting the ecosystem, and want to be very collaborative and supportive, and are going to give you a right down the fairway term sheet. That is sort of the framework when I represent them and I know them personally. That is the framework in which we are approaching that when I'm on the other side of the table. Sure, it's investor favorable, but it is within the bounds of reason and very friendly and supportive. And the reason why I say that is some people's reflexive action is, if I give something, I have to negotiate for something. This is hardball. I'm on Shark Tank. I need to be, a bigger jerk than the person next to me. And that's not going to be productive. This is a very collaborative environment in which you should be raising capital. So the outreach process. So the best way to run, I'll be pretty specific here. The way that I like to do it in specifics is to build 3 tiers of potential partners, potential investors, venture capital funds. You start with the tier that is, hey, I would definitely take their money. I would love to raise money from them. They'd be a great partner, but they're not my dream partner. But they would be great. Then you have a middle tier, which is something north of that, and then it's the dream partner. And what you do then is you start with tier 3 and you work your way up. And the reason is, no matter how many times you practice your pitch in front of your grandmother in the mirror, you're going to get questions that you've never been asked before. You're going to say something and you're going to go, I don't like the way I articulated that. Or I love the way that I said this. Everything in life you get better with practice. And pitching is the same thing. And so the best way to do it is start with people that are, these are real VCs, you'd really take their money. But what you're doing is you're learning. You're understanding they're going to ask you questions and rip apart your deck, and you just want to absorb as much as you can, learn as much as you can, leave, reiterate the deck, practice your pitch after you've incorporated all that information, and you're working your way up. So by the time you get to the tier 1 people, you've had many, many pitches. The other thing that happens is you get a term sheet. And if you start with that very top, I dream partner, Bill Gates gave me a term sheet. It's going to be pretty hard to say, you know what, Bill, I'm running a process here. I'm talking to 5 or 6 other people next week, and I'm going to get back to you. That's a very hard thing to do. You're just going to pop some champagne and sign. You're not going to negotiate the terms. You're not going to continue your process. You will never know if you could have got a better term sheet from fill in the blank. And so it's much easier because this goes in time. This isn't all like one day where you line up 50 meetings. It's going to be spread over weeks, potentially months. And so if you start with tier 3 and then, we got a great term sheet. That's great. Now you can have that conversation much more confidently, and then you have that in your back pocket when you go speak to the tier 2 and tier 1 investors. You have a little bit of swagger. I got a term sheet in my back pocket. And so when you go into that meeting and they say, who else are you talking to? First of all, never ever tell them. Ever. I know this is being recorded and I represent a lot of VCs. Here's a secret. Secret time. They collude. They're Russia. They're Trump. They are colluding over your term sheets. Because A, I have observed it, and B, it's amazing. If you're going to get 3 term sheets, it's all, oh my gosh, it's weird how The valuation and terms all came back radically similar. And then oftentimes it's, hey, it was a $5 million round. Let's increase it to 6. And I actually, you got room for some other VCs that you might want to come in. I'll take 3, and if I lose, other people could take 2. So there's deal sharing, there's collaboration. That's probably a better way to describe it than collusion. But don't tell them. You want to basically run a mini auction or a small process. And so when you have that term sheet in your back pocket, and you can go into those next meetings, it's going to look and feel pretty different. You've practiced. We're now at our dream partner. I can have that conversation. I can answer those questions. And when they say, who else are you talking to? Top tier VCs, your peer firms, and I've already got a term sheet in my back pocket. Great terms, but I want to continue the dialogue and get lots of feedback. Yeah?
Usually there's a lead investor, and then there's other investors. There's other VCs that follow on. And they have to be communicating in some way. How do you, if you're not telling them, how are you going to get follow-on investors? Is that all up to the lead investor? Or?
Great question. So the question was, if you're not communicating with other investors or other VCs, how do you build a syndicate? How do you get other people involved? And the answer is, once you sign the term sheet. With the lead investor. Once the lead investor has signed a term sheet, and there'll be there's an exclusivity provision in there that says you'll work with us, but there's an exception for getting other investors pursuant to the terms of this term sheet. And so once you sort of have haggled off all the terms, ran a mini process, optimized for everything that we can optimize, you sign the term sheet, and then it's, okay, who else should we talk to? Right? I've spoken with VCs that are interested. You now, new lead VC, you have other people that you're friends with that you share deals with. Now that we've aligned on the core economic terms, let's get other people around the table, and there'll be plenty of time in the process to do that. Yeah?
This might be a little bit too detailed, but I'm just wondering how to define the tiers of investors. And for example, if I want to be the next Blue Apron, right?
Yeah.
Do I go to all the VCs already invested in Blue Apron and define them as tier 3 or tier 1?
So the question was, how do you set VCs into the tiers? And the example was, if I want to be the next Blue Apron, do I just look at Blue Apron's cap table and say, hey, those are all the people that I should be talking to? Great question. It's subjective, right? And so what you're looking for are people with investing experience in the space. Right? If I'm a blockchain investor, I'm less likely to invest in a life sciences company. Right? But if I'm A16Z crypto, that's probably a really good partner for a blockchain technology company. So part of it is domain, right? Domain expertise. 2 is, what is the size and reputation of the fund? I want investors with deep pockets, with big funds. They're going to be able to continue to support the company, that have a long track record of supporting their portfolio companies and providing high valuations and being entrepreneurially focused and favorable companies or investors. As I mentioned before, investors live and die by their reputation. And so having funds that have a good reputation and have made lots of investments in your space, it's a good thing. And then it's probably personal fit. Things like geography. Is this somebody that I want to work with? And you're considering all of those things and then coming up with a subjective list. And it's not going to be black and white. Here's tier 3, here's tier 2, here's tier 1. It's rough approximations, right? It's a bit of art. One of the important points that's raised by your question, though, is what about funds that have competitive investments, right? And so most funds are not going to make competitive investments. And so the question becomes, how do you scope or size or define what would be competitive? The definition of competitive is probably more important than the principle, because the principle is pretty easy to articulate. And so what you're really looking for, again, it's art, not science. So complementary businesses are not competitive. I mean, look at Amazon. Let's take Amazon, for example. They're in everything, right? And they have Alexa, and they're big in natural language processing. But their Alexa fund and a lot of their investments are in natural language processing businesses. I don't think they're really competitive. Bezos isn't sitting around going, God, our $500,000 Series Seed investment in, fill in the blank company, that's super competitive with us or vice versa, right? It's not. So it's subjective around that. Now, if you said all the people that own Blue Apron, they're probably not going to raise a competitor of Blue Apron. But people that are in, let's say, the food delivery tech space that aren't directly competitive, that would be an interesting fit for that type of model. Yeah.
So how about if you have two potential strategic partners, each are the giants in the market. So how would you negotiate with them? How would you deal with them? Instead of one strategic partner, you have two.
So the question was, how do you deal with multiple strategic partners? And that's not that uncommon, actually. So I don't think that it's any different than if you have a single one, other than you're doing it twice.
So do they talk to each other also on the front sheet?
It depends. Oftentimes they have different interests. Oftentimes they have definitely different interests. But I would keep them as separate as possible in the negotiations. They're going to have their own legal teams and their own business teams, and they likely are looking at the business from a different perspective. But you will have separate and distinct deals with each of them. And I think it's important to focus on those core principles that we talked about for both of them. But having multiple strategics at the same time is completely fine. And if anything, it gives you more leverage to say, hey, we're not going to give you a right of first refusal, right of first negotiation, even a notice right, because I would have to give it to this person too. I'm going to be able to exclude you from any meeting or any materials if I, in my sole discretion, determine it's competitively sensitive. Because if I don't give that to you, then and you sort of go that game. Yeah. Yes?
As you're trying to pitch your way up through these tiers, what are you telling the first VCs that you pitch to kind of keep them interested?
Yeah. So the question is, as you're working your way through the tiers, which logically takes time, what are you telling the early investors as you're working your process? And that's part of the reason why we start with the tier 3s, because it's easier to push back or to stall or fill in the blank with those investors. And so what you're doing is twofold. First of all, you're candid and transparent. So it's oftentimes, thank you, appreciate the term sheet. It's fantastic. It's an honor. We'd love to be your partner. I'm committed to my early investors and my existing board to running a good process and being thoughtful about it and making sure that we're sort of talking to a bunch of different investors. I've got a process lined up for the next 2 weeks, 3 weeks. I'm going to have to let that play out a little bit, and then I will circle back with you with comments on your term sheet and our thoughts depending on how these other conversations go. Most VCs are professionals, and they would honor and respect that and not, no, you have to respond in the next 5 days or our term sheet's gone. You might get some of that. What is at the bottom of most VC-led term sheets is an expiration date. It's a bluff, right? I can tell you categorically, I've never once had a term sheet that expired on a Monday, and we got back to them on a Tuesday, and they were like, sorry, like, you lost the term sheet. I've never seen it enforced. Most of the time, it says, I'll use March now, March blank, and it usually lines up with like the day that we signed the term sheet. You just kind of like fill it in. So there's that. So that's sort of the diplomatic side of it. There's no easy way for me to describe how to do it other than being thoughtful and diplomatic at the time and reading the verbal body language of the investor, but always being candid and transparent. And then there is, once you do start getting that, it's time to accelerate the process. So let's say that you said, okay, look, I'm going to raise over 6 months. I'm going to start investor, outreach now, but really I'm mentally budgeting 3 to 6 months to get all this done. In your first meeting, you get a term sheet. You go, wow, this is really good. Okay, 3 to 6 months isn't going to work anymore. You now go straight up the list, start hammering folks, and you say, hey, look, I don't mean to apply time pressure here, but I got a really good term sheet. I thought you'd want to take a look at this deal, familiar with your fund. If we can meet in the next week, tomorrow, whatever, that'd be great. If not, I can't guarantee the deal's still going to be here. And it gets people to move quickly. The other dirty secret, again, secret time, that VCs, any venture capital fund can meet with a company and make a decision within 2 weeks. Any period longer than that doesn't mean they're not still deliberating, debating, calling customers, doing diligence, making market research. But if they say, hey, our process is going to take a month, it doesn't have to take a month. Any VC can get their diligence done and a term sheet in your hand within 2 weeks, if they want to. And so diplomacy and then applying some pressure on other people to move more quickly. No easy way to do it, though. Any other questions? Yeah.
There might have been a significant miss. Getting in front of the VCs is not always an easy feat.
Great question. I wanted to make sure we talked about it. So the question was, how do I get in front of VCs? Right? That's not an easy thing to do. And so the answer is, I'll tell you how I typically manage it with the companies that I work with. The best way to do it is to either know them, first of all, if you know them directly. So you've gone to the Create 33, which is the Madrona Labs, deal downtown, and met Tim Porter over, and got his email, and you can shoot it to him directly. That's path number one. That's fine. You have some sort of existing relationship. Path number two is there is somebody in your network that has been a successful entrepreneur that has a connection with them. So many serial entrepreneurs around town that have raised money, they've had all the VCs on their cap tables. If you are a degree of separation or know that person directly, it's, hey, Bob, know you've had Madrona on your cap table. Would you mind shooting this to, Tim Porter? I think he'd be a great fit for my business. And then if that person can pass along the deck, that's great, because it comes from an entrepreneur that knows you, that knows them. That entrepreneur hopefully has made them money in the past. They're going to look at that and they're going to go, oh, that's great. Let me see what Bob sent me this time. If he likes it, I'll probably love it. Number two would be a peer investor or some other investor. So oftentimes you've done an angel round before you're going to VCs. And so most real sort of angels that are around town making active investments, they know most of the VCs around town and in the valley and have a relationship with them, because that's how a lot of VCs get their deal flow. So there's an ecosystem here. And so angels, send referrals to VCs. And so if you have people on your cap table, that is your next best way to get an introduction to a VC to get the deck. And then what I do is I serve as the residual. So I represent, most VC, all the VCs around Seattle, many in the valley, or have been opposite all of them. And so I can get a deck into anyone basically in the country, right? Either myself personally or our firm. And so once people go through the list and they say, hey, I don't have an introduction to NEA down in the valley, they're a dream partner, not a problem, send me the deck, I'll pass it along with a recommendation, that type of thing. Now, what you frequently want to do from a tactical perspective is a deck, a blurb in the email, because people are getting countless decks sent their way. And so what you have to envision is somebody walking through the airport, pulling up their iPhone, skimming the thing that's in there, and then going, do I want to even open the attachment or not? And that's about it. And so, half the time I send out decks every week. Right? I mean, certainly every week I'm sending out a deck for a client or somebody in the ecosystem. And the question becomes sometimes I hear nothing, and sometimes I send it out to 10, and I get 10 people say, yeah, I'd absolutely love to chat with them. Please make an introduction. And it's hard for me to predict, but that's the process. Yeah. Other questions? We're still on the first slide, but that's just fine. The other slides aren't as entertaining. Yeah.
How much information as an entrepreneur I want to put into the deck, like can be sent around in the Valley or in the Seattle community?
Great question. So the question was, how much information do I want to put in the deck? It's going to be sent around. And this is one, I'm really glad you asked, because I wasn't going to talk about this. This is a really good point to raise. People will laugh at you if you ask for an NDA behind your back. Sorry. If you go to a VC and you say, hey, look, I'm going to share with you confidential information, will you sign an NDA? There's a good chance they'll say, nah, I don't want to talk to you anymore. Because it means that you don't know what you're doing at all, and you've never spoken with anyone in the ecosystem at all. So investors meet with so many companies that they cannot be bound by confidentiality. They will forget where they heard this idea or this business plan or that type of thing. And as a policy, they will not sign that. Of course, there are exceptions. I've had VCs sign NDAs for very deep, technical, white-hot businesses where we need to do a deep dive with your CTO and understand what's going on under the hood. And we can sign a very limited NDA that's heavily negotiated. But just, hey, I want to go pitch you? No. They're not. No one's going to sign that. It'd be embarrassing to ask. Now the question becomes, so let me step back. I don't put a lot of value in NDAs anyway. I'm a lawyer, and I'm like, I don't put a lot of value on it. The number of times that I've had to enforce an NDA in my career is 0. And I'm guessing that it will probably remain 0 for the rest of my career. It's such a factually difficult thing to prove. And you have to be so damaged that you're willing to hire a $1,000 an hour lawyer to go bring a lawsuit. The probability of that happening is extremely small. So when I'm advising companies, it's not don't use NDAs, but what you're really doing is you sign an NDA. Okay, that's in place. Now, I am going to present to you the minimum level of information that I can present and still achieve our business objectives. It's going to depend on what the relationship is like, why do they need the confidential information, but it is the bare minimum. And oftentimes, it's never the crown jewels, right? There's very few things that are really that sensitive where if somebody else got that information and the deal didn't go through or they were just a bad actor, that they could use that against us in a competitive way. That's actually very, very rare. Things like financial information, yeah, I don't want my company's tax return on Facebook. But the competition that's, building the same mousetraps, I can be able to use that against us. I mean, everyone knows we're a poor startup, right? It's not a big deal. It's confidential, but it's not really competitively sensitive. So let me use an example. Sometimes in M&A deals, this is rare, but sometimes in M&A deals, we won't even show certain technology until the very end of the deal. I mean, we are doing a $1 billion M&A deal. We have signed a term sheet. We've gone through diligence. We are negotiating the definitive merger agreement. This process has been going on for 3 months. We still have not shown all of the technology yet. Then the acquirer, before they give us $1 billion, is going to darn well see that information. But we are going to make sure that this deal does not blow up. And so that the data site has hidden folders. And even then, oftentimes what we'll do is these people can see that information, these people cannot. Your engineers are never going to see this. Your business unit leads can do things like that. And we have beyond, confidentiality commitments and that type of thing. And these are organizations that are operating and competitive because that's why they want to buy us. So I think it's more important to use street smarts and common sense than it is any sort of document wrapper around that. Yeah. Questions? Okay, let's try. Oh, yeah, go ahead.
Well, related to that is intellectual property, formal intellectual property like patents.
Mm-hmm.
Is that something you would talk about at this stage?
Great. So the question was, do you talk about patents at this stage? And this goes to one where when I'm sitting around with VCs and entrepreneurs having a beer, some people will sort of mock people for their IP strategy, right? For early stage companies to start talking about their patents. And I don't really agree with that. So if you have to know your vertical really, really well. If you are a pure enterprise software company and you go into a pitch with Voyager, an expert B2B enterprise software company, and you tell them that your mode is all these patents that you have provisional patents on, they're gonna sort of chuckle, because by the time your patent is issued and enforceable, your code is going to have iterated so many times. There's going to be so many competitors that it's probably not going to make sense. That's not always true, in particular in AL, ML type stuff. There's definitely exceptions to that, but they'll sort of be like, God, Andy, these guys came in and they spent the full hour talking about their patent strategy. It's a software company, right? It shows that they aren't getting good advice. So I think it's a matter of life sciences companies are going to be completely different. If you have a small molecule that you're protecting or something like that. So from my perspective, IP is a critical part of every deck, in every conversation, at every point in the life cycle, including the early days. However, it needs to be right size and specific for your business and thoughtful. And not in like a backwards looking way, not in a way where I'm saying like, hey, look, VCs are going to sit here and they're going to expect that. I mean, you need to have a thoughtful IP strategy, right? I mean, all technology companies are human power and intellectual property, and that's it. And so you do need to have one. Now, if it's software, it's copyright, it's trade secret, and a lot of your moat is we're going to move faster than the other people and have better software, better developers, and all those kind of things. On the other end of the spectrum, still stick with the tech side. If you have a deep learning, if you have artificial intelligence, things like that, there's a lot of patents in that space. And so combining that narrative with, and by the way, we're patenting out our space and doing operation analysis with the top firm to figure out where our core competencies lie and where people have to innovate around us in building a moat, that's a pretty compelling story. Yeah. All right, slide 2. So 10 minutes left. The next part, I was going to talk about very technical parts that are negotiated in a deal. Do we want to go through that, or are there other more conceptual questions? I want to use the time, 10 minutes, however, whatever's helpful.
Well, the question is, are you going to come back again to go through the rest of the slide deck?
I can always come back. We can do that. So let's burn through some of this stuff, just so you at least know the content. I'll try to move a little more quickly. And I see people taking pictures. All this stuff will be available. I can answer questions. I'm not going to turn into a pumpkin. Okay, so liquidation preference. So liquidation preference is when the company is sold, how does the money flow? This is the waterfall. And so a very investor favorable is what's called a participating preferred. And so what that means is the preferred stock is going to get its preference back, typically 1x. So we put in $1 million, we're going to get $1 million back, and then the residual is going to go to the common stock and the preferred stock on an as converted basis. So if you think about your waterfall, preferred stock gets their money back, then they take as if they are common stock. Very different economics, very different waterfall. I have not done a deal with this feature 2008, 2009 when all the leverage was on the other side of the table. Very, very rare in this market. The next layer down, working from the most investor favorable to company favorable, the next down is a participating preferred with a cap on it. So you get your money back, investor, then you're going to participate until you get 3x your amount back. And then after that, only the common stock will get the residual proceeds. Now the unstated thing here is, and beyond that, the common stock takes all of it. So if you think about your fraction, your numerator is the $1 billion exit. The denominator is how many shares are participating in that event. So you don't want the preferred stock in that denominator for that waterfall. Now the one that is the overwhelming majority, 99.9% of the deals that I do in this market, is a 1x non-participating. So the investor gets their money back, and if they want to take in the residual proceeds, so residual, let's define that real quick. Once you pull your money back, everything that's left, the residual. If you want to participate, you have to convert to common stock. And you forego your preference by doing that. And so when you're building waterfalls and negotiating deals, you'll hear people say it's 1x non-participating, and your interests are aligned with common. So at a certain value inflection point, the preferred stock is economically identical to common stock. The only time that a preferred investor would actually want their preference is in a down scenario. On any other sort of up exit, they're going to want to take on an as converted to common stock basis and forego just getting their money back. Because it's just your money back. It's just you didn't get any return. So it's only the downside that they would want to do that. And I'm going to go in sort of order of importance. This is the most important issue in terms of the economics beyond sort of the headline price and stuff we talked about earlier on. Questions on this, how this operates? So if you're out in the wild negotiating a term sheet, 1x non-participating. Anything other than that is going to be off market and probably not appropriate. Redemption. This is a West Coast, East Coast, I call it my Tupac Biggie issue. If you are raising money from a West Coast philosophical, not always geographical, but philosophically oriented investor, you're not going to have a redemption provision. In particular from smart early investors, because they know that all of the terms that they get are going to get stacked on by the later investors. So your Wellingtons, Fidelities, your T. Rowe's in that pre-IPO round are going to get every term you got plus. So really savvy investors know that we're in the Series Seed, or the Series A. We know that we're going to be aligned economically with the common stock very early because the value is going to go up and our preference is going to be underwater very quickly. And so they'll negotiate for common stock founder favorable terms in the early stage. So what this is do the investors have the right to force the company to buy back their shares? You will never see this in a West Coast deal. East Coast private equity firms, venture funds, they consider this common and they are shocked when I push back on this because all of their deals have it. So it's really who are you talking with, and they're totally bipolar. It's either in every deal or they'll never ask for it. And you should always push back and not have it. In particular, I believe that philosophically, even when I'm representing an early stage investor, I remove this. We're not going to ask for this because it will be used against us by later rounds. There we go. Okay. Automatic conversion. So the concept is, when should our preferred stock automatically convert into common stock? There's consent, there's optional conversion, but when should it be we're forced to do it? And so an investor favorable provision is, it's going to convert if we go public at a price that is 5x what we paid and raise at least $50 million. Now this goes back to my point about smart investors and dumb investors in the early stage. Some investors will just, reflexively say, hey, Andy, your slide deck says investor favorable. I want that term. That's totally wrong, even from the investor's side. The reason is, let's say that it's a good first round, a great first round, it's a great Series Seed. We raised on a $10 million pre-money valuation. That's a great Series Seed round. When was the last time you saw an IPO with a pre-money valuation less than $50 million? 1922? I don't know. Never, right? It's never going to happen. So what do you think you're getting with this term? The answer is hosed by everyone after you. Because every investor is going to get this. It's the Me Too phenomenon, not the bad one. This is the investor Me Too. This is, I'm going to get every term that the other investors got, that's Me Too, plus something. And so a lot of founders will say, well, why do I care, Andy? If I'm not going to go public for less than $50 million, why are you jumping up and down on the table and getting red-faced about this issue? It doesn't matter. It doesn't matter. And the answer is, when we have a $1 billion valuation and we are doing our last round before an IPO, and the investor says, all right, I'll invest at a $1 billion valuation, but me too. I get the exact same terms everyone else got, plus something. Now we have to go public at a $5 billion valuation. That's a big deal. That's a big number. And it's not that you won't convert them. If they think it's in the company's best interest to convert, they'll voluntarily convert, or they'll do it by written consent and automatically convert everyone. But they're going to say, pay me. So in that IPO discussion, your late stage investors, your Tigers, your T. Rowe's, your Wellingtons, your IVPs of the world, they're going to go, oh, that's too bad that the valuation, that the underwriter says it's going to be a $4.5 billion valuation. We're happy to surrender our negotiated rights in exchange for X. And that's the game, and that's how you get squeezed. And when I am in that Series F negotiation, I won or lost that negotiation 5 years ago in the Series Seed. Because if that term is in the document, I will not have the moral authority to stand up and say, I don't care if you're writing a $200 million check or not, you're not getting this term. Doesn't matter. We've never given it. No time in the company's history have we ever given this term to anyone, and we're not changing that for anyone. We will win that argument every single time. If I have to get up and say, hey guys, thanks for the $250 million investment at a $1 billion valuation. I know we gave this to everyone else, even people that wrote us a $500,000 check, but you're not going to get it. That's hard for me to win that argument. And so that's why as we are collectively here, as we as entrepreneurs, as lawyers, as you are working through these terms, you have to skate where the puck's going. You have to have a crystal ball. These points are critical, and it's not immediately obvious. And so for serial entrepreneurs, they've touched the stove, right? They've been burned. They understand how this can operate and how you can get burned. But for people that are doing this for the first time, it's important to surround yourself with good advisors that have been through these battles before and can predict the pitfalls that are going to come in the future. Good lawyers, good advisors, good mentors, and being calm and thoughtful and introspective on your deal and what you want to do. Because when you get that first term sheet, half the time it's awesome. It's the most exciting feeling in the world to work with an early stage company that's been trying to get their term sheet done forever, and they never thought they would get it. They've been working in mom's garage for a year, and then you get it, and you just want to sign the term sheet and give me the check so I can go pay off all my debts and hire a bunch of people and go take over the world. And the answer is deep breath, right? It's not going anywhere. It's more important to do this right than it is to do this fast. And these are the type of terms where if you don't have a 360-degree view of where you came from and where you're going, you're going to touch the stove and get burned at some point. So we're a couple minutes over, so I'll leave you with that. So if there's any quick questions, I can still answer them.
We can go till 5 past if everybody's full.
Great. So there's 3.5 minutes. I'll answer questions and then, or I can do one more term. One more term? All right. Founder favorable. So founder favorable would be no multiple, and I lowered the number. No multiple is fine. That's standard. Okay, anti-dilution. So the way that this works is when you do a priced round, Series A, Series B, Series C, whatever it is, there's original issue price. That's just the price per share. Anti-dilution is if you issue shares below that price, there's an adjustment to the conversion mechanism that results in the preferred stock not converting into common stock on a 1-to-1 ratio. So I did a deal at $10 million. I did Series A at $10 million. I then did Series B at $5 million. There's a mechanism that would then ratchet the Series A down to give them more shares on a fully diluted basis because of the dilution. Okay? That's the mechanism. The point that you might see, but is very rare, but is the investor favorable one, is what's called a full ratchet. And so it ratchets as if you had sold shares at that lower price. It's kind of hard to explain in concept, but if you sold $1 worth of shares at half the price, then the conversion ratio is going to flip so they get 2 shares of preferred stock. Boom. Juxtaposition here is important. Weighted average. This is the founder favorable version. If you sold, it's a formula that weights the number of shares you sold, the price that you sold them at, and is a formula to result in the amount of dilution. So if you sold 1 share at $1 less than your prior price, then it's going to be a lot less dilution than if you raised $100 million at 50% of the price. It's a rational mathematical formula that weights the shares to come up with a weighted dilution. So the investor gets kind of whole, kind of trued up, but it's not a full adjustment. The full ratchet is very rare. I mean, it's a pretty egregious term. Sometimes you use it strategically if you get that huge valuation on that first round. So sometimes an investor will come in and they'll say, look, I really believe in the team. I really believe in the company. I've only done Series C deals between a 5 and a 7 million pre-money. I agree with you that this one is worth $20 million. 3 to 4 times what the going market is for Series C deals. But If I'm wrong, and you come in and do a Series B at a $10 million, whatever it is, any number less than 20, I'm going to get a full ratchet. If you do your next round at above, then the ratchet will fall away. So it's used sometimes very strategically and very tactically, but it's very, very rare. 99.9% of deals are just a broad-based weighted average. I'll do one more. Voting agreement, board of directors. This is going to be one of the top points that we negotiate. We talked about this at the very beginning. A normal construct, and there's lots of, I hate using the word normal. A very conventional one that I see frequently is one founder, one venture firm, and an independent. It's a very common way to do it. Now, the tension point in concept you'll be negotiating is control. The reason why I believe that this is the most common one that I see as well as a very fair one is who has control of this board? Nobody. Right? I mean, it's one of the founders, it's the representative venture fund, and it's an independent. Now, what you can advocate for is, you dream it, we can draft it. 2 founders, 1 VC, right? 3 founders, a VC, and an independent. But I think I mentioned this at the beginning. It's very easy to put people on your board. It's very hard to take people off. And so, smaller is better in this context. I guess I'll pause there. That's probably enough time.